the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything. Interest rates are not the strongest lever to control inflation when you have fiscal dominance. 2023, for that matter, which is decent liquidity conditions and ongoing fiscal dominance in the U.S., which is leading a lot of things to run hot, ranging from nominal GDP to asset prices. And a couple of the key things I'm watching for 2025 is basically anything that would change the course of that or give us some wiggles along that path. And so one of the things I'm watching first and foremost is the debt ceiling issue. Not because I expect much out of it in the long run in terms of all the defaults and stuff that can happen, but rather because when the debt ceiling's being contested, the Treasury has to do extraordinary measures, which they started this week. And that basically means that they have to drain cash from their account back into the system in order to keep paying their bills without issuing that new debt. So the longer that goes on, that's a liquidity factor, which can then translate into asset prices and other things like that, financial conditions broadly. And then also the one of the biggest things to watch is tariffs. That's potentially an all year thing to watch, but especially in the first few weeks and months here to see any sort of announcements around that. So I get a lot of questions around what's the Fed going to do. We obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors, even though, of course, Fed decisions still matter. But at the end of the day, fiscal matters a lot more.
Bitcoin's bull market may face risks as key indicators signal a potential cycle top, raising questions about the cryptocurrency's near-term trajectory. On-chain analytics platform CryptoQuant has highlighted that the index of Bitcoin cycle indicators is now entering the distribution region, which often precedes a market downturn. This marks the first time in 8 months that the index has reached such levels, suggesting that investors could begin distributing coins despite the lofty price targets for Bitcoin in 2025, which range from 150,000 to get higher. The IBCI is an aggregate of 7 popular on-chain metrics, including the pool multiple, spent output profit ratio, and that unrealized profit/loss. Together, these indicators provide insight into Bitcoin's price cycles and help identify potential macro tops or bottoms. While some components of the IGCI suggest caution, others, like the pool multiple, indicate that there might still be room for growth before a definitive market peak is reached. Historically, when the ABSI approaches 100%, markets tend to enter corrective phases and even bear markets. However, it's not yet at full sell-off levels, leaving room for speculation about further upside. Analyst Timothy Peterson recently noted that Bitcoin's current trajectory has a striking 90% correlation with the 2015 to 2017 bull run. Based on this pattern, he speculates that Bitcoin could reach 137,000 before experiencing a significant correction below the six-figure mark. Despite these cautionary signals, Bitcoin's price action remains dynamic, and past indicators have occasionally deviated from expectations. While the risks of a macro top linger, there is still potential for continued growth before a definitive bear market sets in.
So in the intermediate term, I think that Bitcoin is still too small to be super relevant for the things we're discussing here at a $2 trillion market cap. It's probably still too small to really kind of enter these discussions. Now, any sort of decisions around strategic Bitcoin reserve are probably separately considered than trade for the most part. And so, while that could be certainly beneficial, it's certainly beneficial for Bitcoin price. And if I was advising any entity, whether it's a corporation, whether it's a family, whether it's a country, it'd be like, yeah, you probably should have some Bitcoin. If your goal is to maximize whatever thing that you're running, owning more Bitcoin is probably going to benefit you in the long run. So we'll see how that goes. If we look out long enough, then things like Bitcoin and having a Bitcoin reserve can actually affect some of these trade dynamics, because one of these solutions to having a structurally overvalued dollar and therefore a structural U.S. trade deficit, is to instead have more international contracts and more international reserve stored in neutral reserve assets. There's basically two methods. One is you either have a more multipolar currency world. So you say, okay, so some reserves are in dollars, others are in euros, others are in Chinese yuan, and a couple other major ones. Or excess reserves and storage are kind of held in gold or Bitcoin. And now the problem is that the current, the upcoming Treasury Secretary has specifically said that they want to keep the dollar as the global reserve currency. They want that sanctionability. And I think that's where there's some competition. You say, well, we want to reduce the trade deficits, even though the trade deficits are what supply the world with dollars to be the world reserve currency. But we also want to keep the reserve currency because we want to be able to sanction anyone we want. And those are kind of competing dynamics. Now, maybe, decades ago during the Cold War, it was more advantageous to have the global reserve currency than to not. But now that the negatives have kind of accumulated and are front and center in politics, in some ways, ironically, the downsides of being the primary reserve currency might be outweighing some of the benefits. It depends who you are. If you're the U.S. government, you want reserve currency because you want to be able to sanction anyone. If you're Wall Street, you probably want the world reserve currency. But if you're industry, you're kind of the one that's on the wrong side of this whole apparatus. And one of the solutions there is basically say, well, instead of all these countries storing excess savings in dollars, treasuries, and U.S. stocks, save them in gold or Bitcoin or other types of global assets. But that's more of a conscious trade-off that I don't think this administration wants to make. The prior administration didn't want to make it. So I think it's probably a longer-term process, and Bitcoin has to get much bigger before it really enters those types of discussions as a kind of a reserve asset at scale. Right now we see El Salvador holding it. We see the Kingdom of Bhutan holding it. Potentially some Middle Eastern countries holding it. But in order for it to be like this, massive reserve holding among countries, I mean, at least has to get, half as big or as big as gold. So basically have to add another zero to the market capitalization. And then it actually starts kind of being really relevant as, potential alternative as like a large-scale reserve asset.
President Donald Trump has issued an executive order titled Strengthening American Leadership in Digital Financial Technology, which aims to position the United States as a leader in the digital asset space, while the order emphasizes support for the cryptocurrency industry. Bitcoin enthusiasts may be disappointed that it makes no direct mention of Bitcoin, focusing instead on the broader cryptocurrency landscape. The order underscores the administration's commitment to fostering innovation and ensuring fair access to financial services for all law-abiding citizens and private sector entities. It also seeks to overhaul existing regulations, forming a president's working group on digital asset markets. This group, comprising key federal leaders such as the Secretary of the Treasury, the Attorney General, and heads of the SEC and CFTC, is tasked with recommending a federal regulatory framework for digital assets, including stablecoins within 180 days. Trump's executive order also revokes a Biden-era directive that called for CBDC exploration. Instead, it pushes for a ban on central bank digital currencies with an unusually broad definition, potentially encompassing standard financial reserves. Notably, the order introduces the concept of a national digital asset stockpile, potentially derived from cryptocurrencies lawfully seized by the government. While the specifics are vague, this move keeps the promise of a strategic Bitcoin reserve alive. Although Trump's order fulfills campaign promises to his pro-crypto base, its lack of focus on Bitcoin and ambiguous language around CBDCs raises questions about its practical implications. Nevertheless, it highlights the administration's intent to shape the digital financial landscape, offering both opportunities and challenges for the industry's future. Don't forget to like and subscribe, and let's keep this bull run going.